It's no secret that the Fed has been raising interest rates. And I remember when they first started, mainstream media started being like, pay off your high interest credit cards, pay off any high interest debt, the rates are going to go up. And then I started hearing some people talk about how, well, an increase in interest rates on loans means hopefully going to be an increase in interest rates on savings accounts and other types of safe money places. And yes, we've seen some of that happen. And some people assume, well, if I have an increase in my interest rates here and there on loans and on my savings, then it's a washout. I don't have to be so worried. There's some wisdom, though, when you actually run the numbers to see how these compare. And so that's what we're going to do today. We've done all the math. You can sit back and enjoy it and see what you might discover.
Welcome to Wealth Wisdom Financial. We believe when conventional financial wisdom doesn't get you where you want to go, you need wealth wisdom. And that's what we hope to provide for you today in this amazing conversation.
So if you're just finding us, be sure you hit that subscribe button so you don't miss an episode. If you're a longtime listener, watcher, and you're watching on YouTube, please give us a like, and the comments are open. We want you to comment there as well. Now, today's episode, we're revisiting something that came up in an episode we recorded October 11th. The episode title of that one was Escape Financial Lies and Find Genuine Hope. And in that episode, we talked about the debtor's staircase, the saver's staircase, and the wealth accumulator staircase, and how those are different. Now, the biggest problem with that thought exercise that we put there is that the debtors and the savers look too similar, and they don't account for the difference in the impact of interest on savings accounts versus the interest charged on debt. And we all know that bankers the lenders, they charge more on debt than they give on the money that we put with them, right? The lender charges more than the saver receives.
So we are doing this episode because somebody did in that episode write a comment. And again, we read every one of them. We want you to write more so we can create content that answers those questions. And it was from Fermo95.
Thanks, Fermo.
Thanks, Fermo. We want to see the math on interest rates increasing on savings versus debt. So that's what
we got for you today. Okay, I'm going to go over to our handy D&D vibe board and let's play with some math. Ready? Okay, so for today's example, we're going to use a car loan versus saving up to buy the car in cash. We did a home example last time, so we thought let's change it up. Let's use a car. Cool. Yep. Okay. So here's the car. I'm not going to try to draw a car because you don't want to see my drawing. Okay, so let's say you're going to pay for a car with a loan, and the loan interest rate doubles from 4% to 8%. Okay, so you were going to pay 4% on the car loan. It's doubled to 8%. This is real. This is what a lot of people are seeing. Right, you might be a little more, a little bit less, but very close. And let's say you're going to buy a $30,000 car. Actually, let's make this, in both of these examples, we're going to do a $30,000 car. Okay.
Like for like 30,000.
Yeah. So what most people would see is that the monthly payment goes from $553 to $608. And they would say, oh, I could swing an extra $55 in my $55 in my monthly budget. I can still buy that car.
Yeah.
I mean, most people, that's how they think. Oh, that fits in my budget this month. I can, skip a nice dinner, or, I have that extra wiggle room.
Even though it's 8%, it's not that big of a difference.
Not $55, not too big of a deal. Yeah. But when you look at the true cost of the car and you add up all of the interest that you paid, now your interest, the total that you pay over the life of the loan, goes from $3,150 up to $6,498. We'll call it $6,500, more than doubled. So now the total cost of that $30,000 car is gone from 33,000 up to over 36,000.
Yep. I mean, and it is that 4 to 8, so it makes
Right.
sense at least.
Yeah, and if
hopefully,
it went to 9, 10, right, then you're just going to see that go higher and higher. So that's what happens on the debt side.
Yep.
Okay. Now let's look, if you were going to save up for that car, maybe keep driving your junker, take the bus, ride a bicycle, something like that. You're going to save up instead. So let's go save over here. And let's say your savings account, a high interest savings account, a money market account, whatever kind of account you're using. Let's say the interest goes from 0.25, which pre-pandemic, if you're getting 0.25, good on you.
Right.
Right.
Interesting how that works now.
Now let's look at 2.5. So we did a 10 times. Over here, it doubled on the loan side. Here we're doing a 10x. Okay, so the banker just 10x'd your savings rate or your interest on your savings account. Or you move to a high yield savings, something, and now it's 2.5. And you're going to save up for that car. Well, how much are you going to save? Let's say monthly, you're going to save $553. Okay.
Same amount. Yeah.
How many months does it take? At the 0.25, it takes 54 months to save. That should be a 5. 54 months to save up for that car. So over here, you paid up. This is the 60-month loan. It takes 5 years to pay it off.
Yeah.
On this side, you are saving up for it, and it takes you almost 5 years. You get to buy it in 5.5 years instead of waiting, or 4.5 years instead of 5 years to get it. Now, if you have the 2.5, 10x the interest in your savings account as you're saving up for this, how long do you think it takes you to get it?
Oh, I don't know. I mean, I
You're
kind of
getting
know the
10,
answer.
you know the answer. Yeah, 10 times the savings interest rate. How long does it take you? Here it goes. You ready for this?
Drum roll, please.
52 months. It only saves you 2 months until you are able to go buy that car with cash. 10 times the savings rate.
So you increased your savings, the amount they gave you, and you saved 2 months.
2 months.
Versus the other way.
Yeah. At 2.5% interest over those 52 months, you only made a little more than $1,500 of interest.
Wow.
Yeah. Like not even still keeping up with inflation, really. Right.
So then we're not incentivized either. I mean, we think we are, but are we?
Right. So this is where most people think, well, I'll just go have a higher rate of return. Maybe I'll find an even higher interest savings account. Maybe I'll find a CD that's paying higher than 2.5%, or maybe I'll take more risk, because more risk, more reward, right?
Yeah, that's what they say.
Well, before you do that, and you start saving up for your next car purchase in a brokerage account or in the stock market, where you could potentially earn more than 2.5%. If you want to see what that could really look like and how you can make 8% and still lose money when you're pursuing that and taking too much risk, we want you to go back to our episode called Stock Market Loss. Stop being the collateral damage of math destruction. I'll put a link to that in the show notes. It was a great episode we did where we prove with real math that you can make 8% and still lose money. It's not about the rate of return.
Yeah, I mean, say that again. You can
make an 8% rate of return and still lose money.
And that is another thing that, again, we're just looking at the math. We're just saying, what does this mean? Not saying you should not buy a car here or here, but what does the math say? And then make smart decisions. Yeah.
Well, and realizing that an increase in the interest rate on a loan is not the same as an increase in an interest rate on a savings account.
Yeah.
So let's get hopeful for a second. You ready to get hopeful?
I'm always ready to be hopeful. I mean, of course you're the hopeful.
I'm the hopeful one.
I'm the pessimistic.
Here we go. So let's say this person who's saving up for a car, instead of trying to double the interest that they're receiving as they save, let's say instead of 553, they double their savings rate, and now they're saving $1,106. How long does it take them to buy that car?
They are saving more.
They're saving double. This one is not a trick question.
They probably have.
Yeah, it only takes 26 months to save up for that car.
Well, of course.
Yeah. So, and same interest rate. We didn't change the 2.5%. Now, what that goes to show is that sometimes it's the rate of savings that's more important than the rate of return. And if you want to learn more about that, we've got an episode we recorded live that we'll link below as well, where you can learn more about why rate of return doesn't matter, but savings rate really matters.
Yeah.
Now,
volume.
Yeah, we've heard so many stories of people saving up cash in drawers, making no rate of return, and being able to pay for a loved one's long-term care that way when they needed it. We've also heard of people who purchased a used car, not for $30,000, but for $17,000, because they were saving a percentage of their income rather than a flat amount. And they had a good few months and they were able to make it happen in 3 months, save up what they needed to buy the car because they weren't saving the flat amount, they're saving a percentage. And that actually helped them have a higher savings rate when they were making more. And that was more important than whatever rate of return they were getting on that money that they're only going to hold for 3 months till they bought the car, right?
Right.
So the other thing is that we don't want you to feel overwhelmed that you need to like double how much you're saving or anything like that. Even a 1% increase in your savings rate can make a big difference over the long term. Again, go back to that episode where we talk about the rate of savings is more important than the rate of return. Because if you're doing that on a regular basis, you're also going from 1% to 2%, right? You're continuing to increase. You can dramatically transform your financial future. So if you want to take a step toward that future, stop looking for the higher rate of return and look at your savings rate and how you can improve it. I think hands down, that's one of the best dividends that you can give yourself.
And I do think like in some of this is that 1% adjustments that we talk about in the book, in our community, in other areas where it's that making those micro 1% adjustments over time can make huge dividends in what you're going to accomplish financially in your life.
Now, before you start looking to cut expenses, there could be leaks in your finances that, when plugged, give you the ability to save more and be more aggressive about your savings. And we love kind of playing hide and seek to find those leaks in people's financial portfolios and how they might increase their savings rate without hampering their lifestyle. So are you ready to find the opportunity to create a stronger, more in control of your financial future? Well, we'd love to help you find how you could increase your savings rate without cutting your expenses. To do that, you just need to schedule a discovery call at wealthwisdomfp.com/call. Brandon, what's your concluding remarks?
Yeah, it's about understanding how money works a little bit, but really finding out what are your goals? What do you want to accomplish? And is the tools that you have, whether it's a brokerage account, a savings account, whatever it is,
whole life insurance,
does it help you reach your goals? Can you do both? Can you save and still be able to get that nice car? Or do you need to do it that way, right? That's part of our question that we love to ask. Most likely, you need to figure out what are your goals and not just say, oh, I'm going to go buy a car and let the sales guy tell you what it is. You kind of come into it knowing ahead of time where you want to go.
Yep. Make a plan, execute the plan. We're going to talk about that more in our next episode when it comes to how do you achieve financial freedom and what is it going to take? It comes with a plan, but it's a little more nuanced than that. So we look forward to seeing you in the next episode. Hit that subscribe button and live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.
Awesome. See you guys.